Welcome back. Welcome back to another episode of the Wealth Wednesday. My name is Corey Phillips. We are back with another episode. I know we're about an hour late. We're having some difficulties getting this started, but I'm just here to share this information with you all to be able to talk about different market volatility, macro power shifts, long-term investor psychology, because there's so much going on and how we can be able to educate our families, educate our communities, so we can all learn how to build wealth. So we are back with another video. Make sure to like and subscribe. Make sure to share this information so that we can continue to make this show bigger, continue to make it better, and keep up with this consistency. So let me know what you all think in the comment section. Let me know your thoughts on different topics that we should talk about, and then we will go from there. So there's so much going on right now, especially in the community. So we want to make sure that we are informed so we can go and make the best decisions to change our lives. So again, my name is Corey Phillips. I'm a public speaker, entrepreneur, founder and CEO of Social Storm LLC. So I'm here to just share this information each and every week so that people can go and continue to make the best decision for their life. And you want to make sure to like, subscribe, share to your friends and family so that you can go and continue to go and move forward. Okay. We are currently live. Share this to your friends and family. If you're ready, we're going to be back with this instantly. So it's currently February 4th. It's Happy Black History Month. Everyone, all the different entrepreneurs who's paved the way for people that's moving forward. People that paved the way for everything that we've done within the community. I wouldn't be here if it weren't for some of the civil rights activists, people who paved the way for the future. So again, just grateful. Shout out to everyone who's here. There's Black History every single day in my heart. So with further ado, we're going to get right into it. So this is something that we're not here to chase views. We're not reacting emotionally. We're just showing up. We're just pure impact. And this is a lot about understanding what's happening, how investors are thinking, and why discipline matters in moments like this. So the biggest thing in 2026 is we're currently about to look at the big time horizon is the Mega-IPO. We're going to see rumors that swirling that Elon Musk may fold his AI, XAI, into SpaceX, and the goal would create a $1.5 trillion everything platform. This platform would combine rockets, satellites, artificial intelligence, a vertically integrated system spanning defense, communications, data, and intelligence. So this date, markets are eyeing a mid-June 2026 for a possible SpaceX listing. If it happens, it would be the largest IPO in history. This is something that we have to continue to look out for. Of course, a lot of speculation off a lot of things, but if this would be one of the greatest IPOs and hype in the history of the markets. So this is something that we have to continue to look at and navigate as we move closer to that date. Understand SpaceX is not just a rocket company. XAI is not just it's not just an AI company. Tesla is not just a car company. These are all pillars of the ecosystem to move forward into 2026 and understand that they're some of the greatest companies that will ever be created. But time will tell, and we'll see how that goes. We're going to continue to look at a company like OpenAI. It's the company of this cycle was projected $25 billion in revenue for 2026, expected to burn $17 billion in cash this year alone. This cash burn is driven by massive data center expansion, compute, and infrastructure costs. Investors are no longer just focused on ChatGPT. The real question is, can OpenAI actually turn profitable before its own rumored IPO? Is where hype meets financial reality. And when a lot of people talk about today's age, they talk about potentially being an AI bubble. But this is why we look into the AI bubble, look back in history. When the market dips, bubble is the first word that people scream. But here's the ammunition you need to prove why current tech structure is built on concrete, not clouds. Number one, the revenue before listing rule is in the 90s. The 1999 companies were going public with the business plan on a napkin. Pets.com famously went from IPO to bankruptcy in 268 days because they had $0 in profit and no path to get there. Today's profits, look at the gains. NVIDIA isn't just promising AI. They are selling the chips for a 75% gross margin in 2025 and 2026. The Mag 7, Microsoft, Meta, etc., are generating $300 billion in combined annual net income. We aren't betting on the future users. We are betting on current massive cash flow. Look at Cisco versus NVIDIA metric valuation reality. Cisco 2000 was the peak of the dot-com bubble. Cisco was the shovels of the internet. It traded a PE ratio of 200x. That means if you were paying $200 for every $1 the company actually made. NVIDIA 2026, despite having a massive run-up, NVIDIA has been trading with a 4P ratio of over 35x to 45x. The point is that NVIDIA is actually cheaper today than the relative value and growth than Cisco was in 2000. It is growing in its earnings faster than its stock price, which is the definition of rational bull market, not a bubble. And then the fortress balance sheet is self-funding. In the 90s, the Fed raised rates. Tech died because they relied on cheap bank loans to survive. And most tech companies were in debt heavy when music stopped, interest rates rose, and they couldn't pay their bills. But today, you look at a lot of these big tech companies, is that big tech has more cash than most countries. Apple, Google, and Microsoft have roughly $500 billion in combined cash on hand. And they're funding the 100 billion plus AI build out from their own pockets, not from high interest loans. This makes them rate proof compared to the startups in the 90s. So we need to understand that a lot of these companies are continuing to become profitable, investing their own cash flow for future return on investments. Of course, we don't know 100% which things are where the build out will be as far as AI, but we understand that these companies are not in the same predicament as these companies were in the dot-com bubble. So we cannot put that into the same category, different dynamic, a different system, and different technology. So understanding how we can navigate this from fear and hype and stay focused on stuff that actually really matters. Look at the data points, look at the things that are happening, and looking at how the future projections can continue to move forward. It's a totally different time, totally different market. That leads me to my next topic, talking about the changing of the guard. We're going to have a new Fed chair. The most significant shift in the U.S. economy right now is the leadership in the Federal Reserve. President Trump has nominated Kevin Warsh. He would replace Jerome Powell, and Powell's term ends in May. Kevin Warsh's connections also connected to Donald Trump. Warsh was publicly considered by Trump during his first term. He was on Trump's short list for Fed chair in 2017 to 2018. Trump ultimately chose Powell, but Warsh remained a preferred candidate. Warsh has been a long-time critic of quantitative easing, prolonged easy money policy, the Fed spending beyond monetary policy into social and political issues. Trump and Warsh align on inflation discipline, skepticism of unchecked Fed independence, and a desire to restore institutional credibility. And in a lot of his backgrounds, former senior executive at Goldman Sachs, deep experience in capital markets and M&A, and served as a Federal Reserve governor from 2006 to 2011. Was inside the system during the 2008 financial crisis, but after leaving the Fed and entered a private investing and asset management, closely connected to Stanley Duckmeier family office, former chair of the Hoover Institution at Stanford. And what this really means for investors and people is that Warsh is viewed as an inflation hawk, less tolerant of asset bubbles, skeptical of permanent stimulus, and markets are reacting because rate cuts may not come as fast. Liquidity may stay tighter longer, and the Fed's philosophy itself may change. So that's something that's super important to understand what this really means for the markets in the future, because that controls, of course, we're looking at Fed independence. You want to be able to have typically the Federal Reserve is typically considered to be independent of the United States government. But with President Trump wanting more interest rates faster, this can potentially have that risk of Fed no longer being independent. And then moving on to this next thing, we're talking about commodities, bonds, gold and silver, and the Sell America trade. U.S. bonds, European and Asian institution investors are trimming U.S. Treasury exposure because of policy unpredictability with the U.S. government, rising deficits, as well as long-term debt sustainability concerns. So as the United States government continues to go into more and more debt, a lot of geopolitical issues and deficits, and then the markets itself, a lot of these countries have sold a lot of their U.S. government bonds. And this has something to precious metals roller coaster. Gold hit a record high of 5,600 ounces and pulled back roughly 5%. Silver hit an all-time high, nearly $122 an ounce, and it fell 13%. The reason is this is not really speculation, but it reflects a reduced confidence in fiat currencies such as the U.S. dollar. A recent pullback was caused by a rebounding U.S. dollar, signs of easing Middle Eastern tensions, as well as specifically rumors of talks with Iran. Quick market snapshot is looking at the S&P 500, bullish near 7,000, driven by strong tech earnings as well. Data suggests the Fed may stay on pause. Oil is falling due to potential renewed diplomacy with Iran as well. But looking at a lot of the market shakeup, currently Bitcoin is at $71,200. It's dipped to the $71,000, $72,000 range, lowest level since November 2024 election. The cause is the fear of a more hawkish Fed under Kevin Warsh, liquidity being pulled from risk on assets like Bitcoin, such as equities and things like that. MicroStrategy sliding alongside Bitcoin because a lot of their companies bought in Bitcoin at 100,000, so they're continuing to have more and more deficits. So it's important to look at that. And then looking at tech stocks, continue to tumble today. NASDAQ sharply lower. AMD down 17% after earnings, after beating expectations, but forward guidance disappointed. So market is exhausted by AI hype. NVIDIA and Tesla are also down tonight. Also, SaaS Phillips, new automation tool from Anthropic, shockwaves through software stocks for that seat-based pricing is dead, and one AI login can replace multiple employees. And then also moving over to silver. Silver had a sharp sell-off of brutal meltdown of 120, now struggling through 180. The reason is because of a lot of massive margin calls, a lot of over-leveraged traders forced to sell, and a classic liquidity flush on things like silver, which was up 71% in 2025 and had continued to run up in 2026. But for people to understand Bitcoin, is that Bitcoin runs in 4-year cycles. Bitcoin has a fixed supply of 21 million Bitcoin ever created. Every 4 years, Bitcoin undergoes a halving. So each halving cuts a new supply to miners. So this creates repeated supply shocks. The first cycle from 2009 to 2013, early adapters only, price moved from under $1 to over 1,000, followed by the crash of Mt. Gox collapse. Narrative Bitcoin is dead. During that, cycle 2, 2013 to 2017, 2016 halving, retailing speculation, ICO boom, peaking at 20,000 in 2017, 2018 crash. The narrative with Bitcoin was a scam. 2020 to 2021, 2020 halvings, COVID stimulus and zero rates, institution adoption, peak near 69,000, 2022 to 2023 downturn, narrative that crypto is finished. And then 2024, 2026, 2024 halving, ETFs, Sovereign interest, balance sheet adaptation, post-halving rally, 2026 pullback, 71,000. So mid-cycle, where we are now is we're in a mid-cycle volatility. 20 to 40% pullbacks historically normal, but it's driven by liquidity tightening. It is driven by liquidity tightening, not as a thesis failure. But the biggest thing is super important as investors have the psychology is because early cycles reward patience, late cycles punish leverage. Volatility is something that transfers wealth from emotional hands to disciplined hands. Time in the market always beats timing in the market. You've been programmed to be a consumer, not an owner, not a long-term thinker. But this is not about short-term trades. This is about stability. It's about ownership. This is about legacy, and just locking in your family for life. Being able to invest and understand financial education is important. That can continue to change your family from living paycheck to paycheck to being financially free. So this information that we share on the show will help be able to change that narrative communities that we don't know how to invest. It's no longer an option in this economy. It's no longer something that we don't know because there's so much more information out there, more information than ever, but it's lack of actual implementation. So continue to use that for your life, your community, and how we can all build wealth collectively. We're going to keep on building this show each and every week. Back with another episode next Wednesday. Make sure to like and subscribe. And we're going to be back next week with more and more information. You all have an amazing day. Like and subscribe, and I'll see you all soon.